We now continue with our discussion in Unit 3 under Financial Reporting and Analysis, and we look at the specifics around expense recognition. We've already looked at the revenue part of things. Now we're going to look at some nuances around when the expense has to be recognized and how do we go about essentially looking at some of the specific areas where expense recognition becomes important for us, right? So that's the premise. We've already done the revenue recognition part. Now we're going to focus on the expenses recognition part as to how and when do we kind of look at what kind of expenses are going to get recognized. Now, the fundamental principle of expense recognition is that a company recognizes expenses in the period in which it consumes the economic benefits associated with that expenditure, right, or uses up those benefits. So if, for example, the company is paying salary to an employee, the salary to an employee is essentially for a month of work, and the economic benefit of this has been utilized in this month itself, right? So the moment that economic benefit has been utilized, the expense is recognized or booked, right? So as simple as that. Basically, whenever the company deems that the economic benefits of whatever it has paid for have been used, it's going to recognize that as an expense. If the economic benefits are going to come over a period, remember, over a period, we had discussed about this, that's what would be called as an asset, right? When we discuss the depreciation understanding. So if it is over a period, then we have to kind of look at depreciation. But if it is within that period, then you will use the expenditure there. There is a matching principle. Costs are supposed to be matched with revenues. If you are not matching the cost with revenue, there is going to be a problem. An offshoot of this will come in our next section as well, when we are going to look at individual line items within the income statement and understand the importance of those line items. But as a simple principle around expenses, only those expenses have to be recognized which are in line with the revenues that have been booked, which have been taken in order to get some revenues. As with revenue recognition, expense recognition can occur independently of cash movements, right? So inventory and cost of goods sold can move in and move out. Plant, property, equipment, and depreciation, just like everything else, the cash flow is not the same as expenses, right? Expenses can be booked on an accrual basis. Even if you have not paid to someone, that's possible that is booked as an expense because the economic benefit of that has already been utilized there, right? So that is something you have to keep that in mind and understand when you're booking the expenses. Now, when you're looking at expenses, there are two or three major headers which we need to be careful with. One we have already seen in detail, which is around the depreciation bit, which is how do you go about looking for depreciation? Depreciation could be straight line, it could be written down value. Sometimes you also use a method called accelerated depreciation, in which depreciation is much bigger in the first few years and then smaller as you go along in subsequent years that follow, right? So broadly, that's the crux of how you go about looking at depreciation and booking around the depreciation. One of the other key parameters that comes under recognition of expenses is around the inventory recognition or the raw material cost recognition, right? Let's take a simple example and try and understand. I buy raw materials for 100 laptops at 20,000 each, correct? And then another 100 laptops at 25,000 each, right? So the first 100 is at 20,000, the next 100 is at 25,000, right? And then I sell 100 laptops at 30 each. So in my statement, the sales is clear. That's 100 into 30,000, correct? But what do I do for raw material cost? Because raw material cost can be, if I assume that I have sold this 100, then the raw material cost will be 100 into 20,000. If I assume I sold this 100, then the raw material cost will be 25 into 100. And if I assume that I take an average of these two, then the raw material cost is 22.5. That's the half of 20 and 25, correct? Now, what do I include there? Because that's going to be a tricky issue. Whether I take in and assume that the first 100 laptops for which I got the raw material, those are the ones which I'm selling. Whether I assume that the last 100 laptops for which I got the value, I sell them, or whether I just assume that, whatever my price point is, I will take an average and then consider the average cost of those. Now, it is important for us to understand this because in one case, you're going to get the expense as 100 into 20, which means your profit also will have three values, can have three values. Your profit can be 100 into 10 or 1000, 10,000 essentially multiplied by 100. Your profit could be 100 into 5 if you take this 30 minus 25, or your profit could be 100 into 7.5. If you leave it open for judgment, correct? If you leave it open for judgment, then in a period where the company wants to show big income, they will show this. And in a period where they want to pay less tax, they will show this. So if they show lower profits, they have to pay lower taxes, correct? Let's actually build this. Let's actually build this once quickly. So I'll just quickly erase this. So we are saying each laptop is sold for 30,000. If my cost is 20,000, my operating profit will be 10,000 and my tax payment will be 3,000, assuming a 30% tax, right? So I'm left with a profit of 7,000, but that's the tax payment, right? If I want to minimize the tax payment, I will show the cost as 25,000, in which case my tax payment is only 1,500. And while my profit is also lower, remember that profit can be made up later because I will still sell it at 30,000 and the next unit will pay lesser taxes. And the third way is I can show this, in which case I'll be somewhere in the middle, right? So this will be 2250 and 5250 is my profit. Now, which one of these three makes sense? Correct? So to understand this, we need to understand the basic principles that go under inventory recognition. What we have outlined here are three principles. Here, we are assuming the first laptop that comes in is the first laptop that goes out, right? That's a principle called as first in, first out, FIFO. In this case, we are assuming that the last 100 laptops that came in, those are the ones that are going out. That's a principle called as last in, first out, or LIFO. And the third one is nothing but a weighted average method. So you could use these three methods of inventory recognition. First in, first out, where the first item purchased is assumed to be the first item sold. The inventory acquired first is used to calculate the cost of goods sold for the period, right? So earlier, the first thing that comes in. So in our example, this would be the inventory acquired at 20,000. That will be sold. The LIFO method is the last item purchased is assumed to be the first item sold. In this case, the inventory most recently purchased is assigned to the cost of goods sold period. In our case, that number will be 25,000. The weighted average method makes no assumption about the physical flow of the inventory. The cost is calculated by taking the total cost of available goods by the total units available. Average cost is used to determine the cost of ending inventory, beginning and ending inventory, correct? So that's the three methods that are there. And you will realize that in a period where, so let's outline that. FIFO is first in, first out. It assumes that the earliest items purchased were sold first. When prices are rising relative to the two other methods, so in our example, 20,000 was going up to 25,000. So this is prices are rising, or you have an inflationary period, correct? That's when raw material prices are going up. Then cost of goods sold will be lowest under FIFO method, because if prices are rising, you are using the lowest price for cost of goods sold. Also, ending inventory value when prices are rising will be highest, is because you are left with the last inventory when the prices are rising in FIFO. In LIFO, it is exactly the opposite. You are using 25,000, so your cost of goods sold will be the highest, and what is left is the earlier purchased inventory. So in a rising price scenario, the earlier purchased inventory would be at a price point of 20,000 essentially, correct? So that basically builds your number there. And then finally, in weighted average, you'll be somewhere in the middle, obviously, because you have kind of averaged out the price movement across a higher or a lower number, right? That's your inventory recognition problem. That's what is used. Now, under Indian GAAP, usually you're going to use FIFO or weighted average. LIFO is usually not used or not allowed, purely because LIFO lets you a subjectivity coming in as to what units are getting sold. So as a method of simple principle, you either take an average if that represents the situation correctly, or you use first in, first out. What came in first goes out first. Simple method, no complications, simple assumption around it, right? That's what we do for inventory recognition problem. Let's take an example. I buy raw material for 200 water bottles at 20 rupees each and then 100 at 25 each. If I sell 250 water bottles during the year, what is my cost of goods sold? Right? Based on LIFO, based on FIFO, based on weighted average. So let's look at the cost of water bottles. Raw material is 200 at 20, so that's 4,000, right? And then another 100 at 25, so that's 2,500. So total is 6,500 and total number of bottles is 300. So if I divide 6,500 by 300, that will give me the weighted average cost if I'm selling 250 bottles, right? So per bottle, that will be around 21.6 rupees. So 250 bottles into 21.6 rupees is what is going to be the value based on weighted average. Based on LIFO, last in first out, I'm going to first use this 2500 and then use another 150 into 20, right? So I'm going to use the last in bottles first, which is this 2500, and then I'm selling 150 more because of the 250 number here. These are at a price of 3,020 each. So my weighted average cost, my cost on the basis of LIFO will be 5,500. In the case of FIFO, I will first use the 200 that came in at 20, so that's 4,000, and then the 50 that came in at 25, so that's 5250. Sorry, this is 1250, total being 5250. So in the case of FIFO, this will be 5250. In the case of LIFO, this will be 5,500. And if I multiply these, this will be somewhere in the region of 5,400 or so. Correct? This will be somewhere in the region of 5,400 or so, approximately. So if we go back to the previous chart and we look at the values, if we use FIFO, the cost of goods sold is lowest. If we use LIFO, that's the highest. And if we use weighted average cost, that's the middle. Lowest in FIFO, highest cost of goods sold in LIFO, and based on weighted average, it's somewhere in the middle. Correct? That's basically how you go about solving the problems of expense recognition or inventory recognition. As we come towards the end of revenue and expense recognition, we'll also take another quick example of revenue recognition. A road project, let's say, is going to get completed in 3 years. The total revenue expected is 800 crore, while the total cost expected is 600 crore. What would be the revenue in 1, 2, 3? Remember, now this is a road project. It's going to get completed in 3 years. So this is a long-term contract. Long-term contract will obviously have recognition in 1, 2, 3. In long-term contract, remember, we use the percentage of completion method. And how do you look at what percent is complete? You look at the cost undertaken already, right? So the total cost is 600. This is year 1, this is year 2, this is year 3, right? We're going to look at sales and we're going to look at costs. How much of the cost is taken in first year? That's 120, 420 in the second year, and 60 in the third year. As a percentage, 120 by 600 crore is 20%. 420 by 600 crore is another 70%, and then 10%. So 20% of the revenue of 800 crore will get booked in the first year. That means 160 crore comes here. Another 70% gets booked in the second year. That means 560 crore will come here, and the last 10% is booked in the third year. That means 80 crore will come here. So under the percentage completion method, that is how your income statement would look like. That's broadly how you go about doing revenue recognition for long-term contracts. We've already incorporated the looking at inventory recognition. These are some of the major principles. Usually you're going to use FIFO, so don't worry too much about it. It's always good to know, however, what the impact of LIFO is going to happen when you're looking at inventories in the context of any company, right? So that's the broad premise of revenue and cost recognition. As we end this section, there's a quick question. It's a variant of the earlier question we had done. I buy raw material for 200 bottles at 20 each, and then another 200 bottles now at 15 each. Earlier there was 100. So 20 is 200 into 20, and now the cost is going down. So this is a deflationary environment. Inflation is negative, right? If you're selling 250 water bottles during the year, what is your cost of goods sold based on LIFO, FIFO, and weighted average? Try this question as we end this section. Thank you.